Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get back to the other story of the morning, and that is what's happening with Google. So joining us is Mandeep Singh, Bloomberg Intelligence Senior Tech Industry Analyst, on a potential Google breakup. Okay, so the DOJ considering asking a federal judge to force Google to sell off parts of its business. What do you think is actually going to happen?
Well, so there are three big lawsuits out there against Google in the U.S. Two from DOJ. One is the monopoly lawsuit, which they lost, and that's where we are looking at remedies. The other one is also from DOJ against their ad tech business, where the DOJ is looking at their ad tech stack and how, they control all parts of the stack. The third one is from the, different state attorney generals, again, targeting their ad tech business. So when I look at, everything that obviously regulators want to change with Google, the ad tech piece is the one which comes up over and over again, the fact that they control different parts of the ad stack. Now, in the monopoly lawsuit, they're talking about a forced breakup of the Chrome business or the Play Store business, Android business. I think it's very hard to take out, a single product from a company like Google and say this is a separate entity. It's just like it's all run on shared infrastructure. I can't imagine, doing that with Google and doing it successfully in the sense that Android can be a separate company. Maybe YouTube, but again with YouTube, it's run on that same infrastructure that search is run on. So how do you split that infrastructure? It's very hard to do it at the product level.
All right, here's some inside Bloomberg for you. You want to get really smart on a new piece of information that just hit the tape about a company. Type in the ticker, GOOGL for Google, hit equity, and then hit BICO, B-I-C-O for Bloomberg Intelligence Company Research, and you'll get what's called a recent event reaction. So I want to know immediately what Mandeep Singh thinks about this stuff. And what I read, I didn't expect to read. We see a breakup of Google's ad tech business as the most likely outcome for remedy in the company's monopoly case with the U.S. Justice Department. I thought what I would have read is, don't worry about it. But this has some teeth here. This is what you're kind of telling me.
Because they lost that first lawsuit at the DOJ, and the second one, the ad tech as well, it's very likely that the judge will rule against Google. Okay. So when you lose the cases, there has to be both behavior and structural remedy. And in the case of behavior remedy, they can't make those payments to Apple anymore to be the default search or any other hardware maker. They'll have to open up Android to offer search screens so that you just don't have to use Chrome or Google search. You can use Bing search, for example. So choice screens is another behavior remedy. But the structural remedy in terms of a forced sale, I find it hard to believe that the DOJ will ask them to sell a product. It has to be more at the technology stack level.
So when we go to the ad tech stack, maybe that just dovetails with what you were saying. So what does control the ad tech stack mean when you're talking about Google?
So think of how an ad exchange works.
Okay.
You have the supply side, in terms of the publisher ad inventory, and then you have the demand side, the advertisers who are buying those ads. And then you have the exchange in the middle who is matching the supply and the demand side for ads. Google has products across the stack where they have a demand side platform, they have a supply side ad platform, they are an online exchange. And they've built it over the years because they made a few acquisitions. DoubleClick was the most notable one, where they acquired all the capabilities to really operate as an entity that knows everything when it comes to digital ads being sold in the marketplace. So they control that stack end to end. That's why when you compare Google's ad pricing to everyone else out there, they are far superior. One, they have the best targeting. The other is when you're operating a stack where you have the dominant product across the different pieces, you have a pricing advantage. And that's what, the regulators are saying, that this company controls pretty much everything in the ad stack.
But the advertisers themselves, they're not complaining.
Of course not. I mean, they're getting the
that's the thing.
ROI on
See,
their
this
ad
is
Like,
spend.
who are they protecting?
This is a solution in search of a problem here, in my opinion, because I have
Right.
competition in this market. I think I have competition. I mean, Google's huge, but so's Facebook. And now
Yeah.
I got this little company out of Seattle called Amazon. They're a monstrous advertising player.
Yeah.
So where's the problem here?
So it all comes down to how you look at the market. If you look at the market the way you just described, where Meta is as formidable as Google and Amazon is a big third player, then yes, there is competition. But when you look at certain type of ads, whether it's on the desktop or the third-party ads that are going through Google Ad Exchange, these companies don't overlap. Like, remember, Meta is a walled garden. Even though it's big in terms of the digital ad advertising, it's its own walled garden. Amazon is its own walled garden. Google, so these companies have their own swim lanes. They are big in terms of the digital ad dollars, but they have their own swim lanes. They don't overlap. And that's the objection that I think regulators have.
Okay, so if they wound up, moving around that ad tech stack and changing stuff up, what does that change look like, and how much money could then Google lose?
Well, so Google search obviously is a $200 billion run rate business, still the cash cow for Google.
That's unreal.
So that's where, the Google network piece, which is the ads that Google shows on third-party platforms. So one is Google showing ads on YouTube and their own search page. The other is Google showing ad on, let's say, a New York Times or some other publisher because it's going through the Google Ad Exchange. That's the part that can be divested and it's a $32 billion run rate business within that $200 billion. That's the part that's not growing, but you could argue could be split up in a way where I think Google may be a smaller search ad business, but at the same time that will appease the regulators because they're not controlling different parts of the ad stack.
When you talk to institutional investors out there these days, how do they think about the regulatory risk over big tech these days? And how has that changed over the last 3 or 4 years?
I mean, right now, everyone wants to know who will be the dominant player when it comes to LLMs and, generative AI, whether Google will end up losing its dominance in search because of these LLM players. And that's where I think, again, the products that Google has, whether it's Android or YouTube or cloud, they're critical to maintaining Google's lead in that LLM and generative AI space, where they do have competition from OpenAI, Microsoft, and that's what investors are most focused on. It's always about the future, 5-10 years down the line, and that's where the growth is, and the companies with the best large language models have an advantage. And Google, because of the fact that they own these family of apps, they have a data advantage for the large language models. It's their proprietary data. So they don't want to give away YouTube or, just have that separate in terms of
Right,
how
they need
they
it.
Yeah.
It
So-
feeds the beast, in
Exactly,
essence, for lack of
yeah.
a better word. They don't have to buy to feed the beast. Okay, so when we wind up hearing numbers and earnings, what kind of growth are we going to see for these big tech companies? And what's going to be considered good? Like 18% growth, is that going to be good enough or what?
I mean, right now we look at Microsoft growing mid-teens. Obviously, the growth part of the business is Azure Cloud. In the case of Google, look, search business may probably grow, low teens. It still is growing double digit, which is remarkable for, a business of $200 billion run rate. That just goes to show that Google search still dominates, and that's why they get so much regulatory scrutiny. But the growth part of the business is the Google Cloud business. I think that's where you will see the growth, 30% growth, and it's driven by companies deploying their, large language model, deploying generative AI. Where do you do that? You do that on the cloud, and the cloud side is big enough for, all three players, whether it's Microsoft, Amazon, and Google, to do well. So I think we'll see a lot of cloud business. And YouTube, I think, is a great standalone business, but there is a cyclical element to it, and that's why YouTube isn't growing as fast as their cloud business.
Well, the reason we have like 27 tech analysts at Bloomberg Intelligence, I mean, they're all over the place, is because I think the U.S. just said 50 years ago, just light touch on regulatory. Let these guys in Silicon Valley do their thing. And that's what created the great technology boom, in my opinion, as opposed to Europe, which you got nothing.
Right.
So now I'm not sure if the cat's out of the bag for a lot of these things. You know?
I don't know.
I don't know.
It would make life more interesting, though, for our antitrust Bloomberg Intelligence people and Mandeep.
Gives him a job.
All right, Mandeep, thanks a lot. Mandeep Singh joining us from Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix Steele alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. For the last few days, though, Paul and I were in Orlando at a Commonwealth Advisors Conference, and Orlando was getting a little bit dicey. The winds were picking up, you had rain, and it looks like that Hurricane Milton is just barreling towards that west coast. And it's very, very dangerous, particularly for those on that west coast. So you want to take a little bit of a deep dive to kind of understand what it means, say, for power and utilities and the grid, because no doubt power is going to go out, but how long it stays, etc., is going to be very pivotal. Mike Sullivan is energy and utilities consultant at PA Consulting, joining us now. Mike, this is a very silly question, but how does a hurricane like this impact the grid and utilities? Like, what's the sequence of events of how this plays out?
Okay. Oh, good morning, and thanks for having me. At first, it goes without saying that Milton is on track. This will probably be one of the most destructive hurricanes in Florida history, and there will be extended power outages, both from winds and the wave surge. So both of those things will be in play. I think the most important thing is for the public to remember that the local officials are first and foremost their choice for information. These emergency management organizations. They are the glue that provide coordination between the state organizations, federal organizations, and first responders like utility workers. And right now there are some estimates that saying there were over 35,000 out-of-state utility workers who have converged on Florida to help in restoration. So it's going to be a huge effort. It's going to take days to restore power, and it's quite a job the utilities are up against.
So, Mike, give us a sense here of kind of the risk to Florida here. I mean, they've been through this so many times, unfortunately. What have they done? What can they do? What should they do to maybe try to, I don't know, safe-proof their grid perhaps a little bit more? Is there anything that can be done?
Sure. There's actually a state law in Florida that requires that utilities file storm protection plans every 3 years. The basic construct or compact that utilities have is to provide safe, reliable, and affordable power to all customers. Over the last decade or so, that has layered on top of that has become it has come into play two other objectives: the clean energy transition and hardened and more resilient grids. So all the utilities have filed these plans to make their grid stronger, to withstand events like this, to be able to restore power faster, and then to think about the overall survivability of the communities that they serve. I think it goes without saying that the number and the impact of the kinds of events we've been seeing in recent years requires that greater investments be made. Those protection plans are good starts, but these grids are expansive. They've been built over 100 plus years, and they need to be hardened and also expanded to support the clean energy transition and greater electrification due to data centers and a lot of other increasing electrical load.
Who pays for that? Is it going to be utilities and the ratepayers, or is it more of a grid operator? Is it the government? Where does that come from?
Yeah. So mostly, I said part of utilities compact is to keep rates affordable. All of these investments cost money. I mean, you're rebuilding major parts of the grid. And yes, ultimately, it does come down to raising rates for ratepayers.
All right, so Mike, you think about our grid and you just look at the wires strung on these poles. It just seems like so technologically out of step with where our economy is. Underground wires, isn't that the future? I mean, as long as stuff's above ground, it's going to be at risk to, hurricanes and all kinds of weather.
Talk about being expensive and ratepayers paying more.
Sure. Absolutely. And for the last 30 years or so, all new communities are supplied with underground service. So that's been going on for some time. It's the older infrastructure. Oftentimes, communities are served. They were built in the 30s and 40s with what we call rear lock construction. That's lines that run behind people's backyards and butt up against other backyards. And those overhead lines are the ones that are particularly susceptible to coming down and taking an awfully long time to put back up because they serve only a few customers.
So when you say that, so a lot of investment needs to go in to help all of these things, whether it's the energy transition or it's weatherproofing, et cetera. And you mentioned that ratepayers eventually are going to have to pay. I mean, there's only so much tolerance for that. Do we know an estimate of what weatherproofing this industry as well as energy transitioning this industry is going to cost?
Yeah. So part of the problem is that oftentimes state regulators who approve these plans don't adequately consider what I call stack value. Is you are trying to build and upgrade your grid for more renewable resources, greater electrification. That is, they have to have more capacity, and at the same time to build them back more resiliently. Those two things, when you think about them as a stacked value, it becomes more understandable, more digestible. Estimates for undergrounding, it's very expensive. Ford and Power Light has a particularly extensive undergrounding program underway right now. But it's $1 million to $2 million, depending on which part of the country you're talking about, to underground lines. And most of the lines that are overhead and cause most of the problems are ones that run up and down city streets, commercial areas, that kind of thing. And even in the best case, whether they're hardened or not, oftentimes in major hurricanes like this, it's not just trees toppling on lines, but it's flying debris hitting poles and lines and things like that. So an event like Milton is particularly problematic, but increased investment can certainly help.
Hey, Mike, thanks so much for joining us. Really appreciate getting your insights here. Michael Sullivan, he's the energy and utilities consultant for PA Consultant. They're based down in Annapolis, Maryland there. So again, the hurricane barreling towards the west coast of Florida. John Tucker and I read the book, The Grid, so we consider ourselves.
Oh, you did? Wait,
we're experts now. Yeah.
Yes, we're experts. We're ready to.
All right, fine. I'll put
But
on the
you
list.
look around, and the technology looks like 1920.
Oh, absolutely.
Oh, yeah.
And you're like, really? I mean, can't we do anything? But as Mike Sullivan was saying, the new stuff gets built. It's getting built underground. So prayers out to our good friends in Florida. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, in the markets, what do you do if it's still going to be higher for longer, in that maybe we're pricing out some cuts by the Fed in 2025? This year may be a done deal. Next year, though, the market has repriced a bit. So let's get some details with Shelby McFaddin, investment analyst at Motley Fool Asset Management. Shelby, it's always so wonderful to speak with you. One of my big questions is, if we do get a longer economic cycle, and the idea is higher rates for a little bit longer, lower than they are today, but still relatively higher, can stocks continue to beat bonds? And if so, where in stocks?
Yeah, I do think that the battle starts to get a little bit closer because really the question is, when will consumers, or investors rather, make that switch from bonds to risky assets, right? So the fact that stocks have continued to beat bonds thus far has already been something that's a bit more of a phenomenon, and we know the main leaders that are driving that. So it would really have to be a matter of, in my view, yields coming down to such a level that they're higher than we've been used to over the last 4 years or so, but not quite high enough to justify completely coming out of risk assets. So I think that's the sort of fundamental part of it. I think the second part really comes from the narrative, right? What is it that these growth companies claim to be offering? What is the secular shift that's going to propel so much of this growth? If the growth is not going to be broad, if it's going to continue to be concentrated, then I think it might be a little bit more of a tussle between the two for stocks to keep on winning.
Shelby, I'm just a little uncertain about the consumer. Yes, I like rates coming down, and I think that's good for the consumer. But how do you guys think about the consumer and owning stocks that are dependent upon the consumer and retail spending?
Yeah, absolutely. I mean, from what we've seen from a lot of the banks, the payment processors thus far, and of course, knowing that we've got banks coming up soon, has been that consumers, for the most part, are doing okay. That's not to say that inflation is completely over. That's not to diminish the fact that in some locales it's a bit more significant and over certain goods and services. But for the most part, people seem to have adjusted. They have definitely spent down savings, so discretionary is a little bit lower. But they have figured out how to live on the income that they have. The job switching has slowed down a lot. So we're not as bearish on the consumer as a whole as some others might be. But in terms of playing the consumer, that's where the active management comes in. We take the time to pick the companies that are run well. They have great operational leverage. They can go ahead and move with the consumer as they need to. So that's why we've got companies like Costco in our Motley Fool 100, in our Global Opportunities Fund. Those are names that are consumer facing, but they tend to do the best out of their peers because of how nimble they are.
Which also on your list is American Express. And the idea typically is that, American Express caters to higher income earners. So if you're looking at the K-shaped economy, that part of the K is actually going to do really well. BTIG actually cut the credit card company to sell from neutral, saying that fundamentals are slowing for those super prime customers. What do you see?
Yeah, so for the one thing, we do know that they're a little bit sticky. And yes, we have that slightly longer runway for higher end consumers, but they tend to have already made the big decisions to get rid of large bills, right? So if they've sort of held on to that annual fee card for about 2 years in this tightening cycle, they tend to be in that part of their elasticity curve where it's kind of like, you know what, we're good to go here. Even though we may be in a little bit of a higher for longer situation, there has been some relief, right? There has been some relief on credit conditions. And if we even get another 25 basis point cut this year and maybe another one in Q1, that makes even better conditions for going a little bit down market. Now, in looking at American Express, they're not interested in going completely down the river. That's not really their prerogative. But there is an opportunity in the high earning categories of Gen Z and young millennials that they have an opportunity to go ahead and catch, but also knowing that these earners have a little bit short of a credit history. So as credit conditions soften, there is an opportunity there to go ahead and get a little bit more of the market to go ahead and adhere with their already sticky premium base.
I'm still a green card holder. They try to upsell me for all the other stuff. I'm like, I'm staying with the classic green card.
Okay, here's my thing with that.
Use what you need.
So
I know.
My husband has the purple fancy one, right?
The what?
Somehow I only have the silver one, but I'm the one that spends all the money and pays the bills. And I don't like that. I don't like that at all. And somehow, like, I'm not in charge of this. It's still under his
What does
name.
that
It feels
cost
a
you
little
a year
antiquated.
now?
Me?
Green card.
Him, nothing.
Nothing.
Me, I think it's $500.
Oh, geez.
Oh.
That's such a scam.
Nothing for
please.
five.
All right, Shelby,
No.
I get reimbursed.
let's go where John and I shop, Costco. It's not just for the $1.50 hot dog. Talk to us about the Costco story.
Yeah, the Costco story is one of just prime operators. I mean, I think that's the simplest way to put it. So they were able to navigate not only supply shortages in sort of the mid-days of the pandemic recovery period, but also navigating the depths of inflation, or the heights, if you will. They were one of the few companies that was boasting about lowering prices. So not only do they have this annuity model where they're going to be making the majority of their money in terms of absolute dollars, but in margin on the annual fee that they're charging, but they're able to garner more consumers by saying, hey, we're going to give you the best deal you can get obviously in a large amount, so as long as you have enough room in your house. But they're able to keep people in that regard. And because it's an annual fee, it's something you budget for once and then it sticks. Also, knowing that they were probably going to have more in stock, having that really robust shipping network allowed them to hold on to people. So, just I think consumers knowing that Costco is sort of on their side is a breath of fresh air compared to some of the other retailers. So, the operators there, the succession planning went fantastic over the last 12 months. No one's really had any concerns, and there's a huge opportunity for e-com. A lot of folks really just kind of trudge through it on the sort of legacy platform. There's that Instacart partnership they have right now, but we give Costco another 5 to 10 years, they may really have something to compete with some of the peers on e-com.
All right, Shelby, we always appreciate you. You have the best stuff, honestly. Thank you so much. Shelby McFaddin, investment analyst at Motley Fool Asset Management, joining us from Alexandria, Virginia. Wait a second. They have a $1.50 hot dog? Still?
Yeah.
Still?
Or $2.50. What is it, John?
I buy them in bulk.
No, it's what is it? $1.50?
No, but the one where you go and you get it
fine.
like in
Yeah,
live. You get it live.
Right by the door there.
It's to die for.
I still don't have a membership.
I mean, Lisa Mateos.
Hey, how can you shop there without a membership?
He doesn't shop there.
You want to tell her?
Oh, you use someone else's membership. I got it.
I'm
Look
not
at
admitting.
me.
I admit to nothing.
Look at me being all smart. All right.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We announced that Disney was closing.
Yes.
Paul got in the nick of time.
Yeah, so I was there. When was I there?
You
Sunday.
were there Sunday and Monday.
Sunday. Yeah, Monday, a little bit Monday. And even during the rain, and it was raining, it didn't stop people at all. You buy the poncho for like $15 each. But you buy the poncho, and they're just standing there. And you know, Disney's a place. It's kind of like when I go skiing. I don't even think about the money I'm spending because that would be too upsetting and it impact your enjoyment of what you're doing. So you just kind of shut your eyes and go. That's how you do it at Disney. Yeah. But apparently there's going to be a financial impact to this whole thing.
Interesting. I wonder how long. I guess it depends on how long it's going to be closed and if there's going to be flooding and all the like. Fortunately,
we pay somebody to think about this stuff. Geetha Ranganathan, she's a media analyst for Bloomberg Intelligence. One of the big names that she covers is the Walt Disney Company. She knows it back, inside and out. And, Geetha, I've covered Disney for a long time, and we never really cared that much about the theme parks. They were a nice business. They contributed nice profits. They kind of grew every year. But now, if you're thinking about the Walt Disney Company, investing in the Walt Disney Company, you better be really bullish on the theme park business because that's now the major part of their profitability. So talk to us about the theme park business and what might be some of the risks for shutting down Walt Disney World.
Yeah, absolutely right, Paul. So it's about a third of revenue, but it's about 2/3 of profits.
Wow.
Almost 60 to 65% of profits. And that is a complete shift, as you correctly pointed out, from just a few years ago, maybe even just 5 years ago, before they kind of went into the streaming business, before the linear TV business kind of is seeing the secular declines that it is right now. So it really, the picture has kind of completely changed. And that means there is a lot of attention and a lot of focus on the theme parks. We do have, some prior hurricane closures to go by. So they had one in 2022, which was Hurricane Ian. When they closed the park for 2 days with Hurricane Ian, they lost about $65 million. That was the operating income impact. You had Hurricane Irma in 2017. There was a $100 million impact. We think, though, that with more and more reliance on the theme parks, just with the fact, that it's become a bigger revenue contributor, a bigger profit contributor, obviously the financial hit is also going to be larger. Remember, just the Florida parks pull in roughly 135 to 140,000 visitors every single day. It's 50 million visitors a year. So, it obviously has huge ramifications. It's losing roughly, $50 million per day. We think the operating income impact will be at least 125 million.
So this is the first time I've been to a Disney property as a civilian. The other times I've been to a Disney property is always with Bob Iger walking next to me. Mm-hmm. So with that analysts and investors and things like that, when they either close the park, so we're the only ones there, or they give us like some super duper passes that we can just zip in any line. This is the first time I went as a civilian where I had to kind of wait in line and do all that kind of stuff. But
And
Gajillions of people do it, as Geetha was just saying.
At the airport, when, there were definitely reports of little children being just sobbing because they had to leave Disney. So you said they're losing $50 million per day by shutting down Disney World. Like that's how big that Florida resort is for them. I heard that right?
Yes, absolutely. Yes.
So
yeah, go ahead.
Do they make that up? Is it then that pent up demand, or is this just lost?
This will pretty much be lost because remember, it's not just the park closure. There is obviously going to be some, longer ranging repercussions for, all of the theme park businesses in Florida, in the Orlando area. So we are actually expecting attendance itself for the fiscal first quarter, which is the current quarter, to actually be down maybe about mid-single digits. Wow. Attendance was flattish in the September quarter. There is definitely pressure all around, and this obviously is not going to help them at all. The other thing that we're watching for, Alix, as we kind of get into 2025, and this is going to be a special pain point for Disney, is that Universal, its closest rival, actually has a new theme park that they're opening in Orlando, and that basically doubles Universal's footprint. They're adding Epic Universe sometime in March, April of next year. Again, a lot of people have been holding back on their travel to Universal because they know this new attraction is coming. And so again, we think that's going to be a little bit of a hit for Disney once we get into 2025.
It's funny you mentioned that, Geetha, because I rode home with a Scottish family. They were on their way back to their home in Dundee, Scotland, and my seatmate, my new buddy, Rayleigh, I thought he was 18. He turns out he was 13. Huge. They're growing and big over there. But they came, as a family, over from Scotland to Orlando just to go to Universal. They didn't go to Disney. I'm like,
really?
Wait a minute. So I turned around and asked his mom, this kid's telling me you guys came all the way here and you just went to Universal. And she said, yeah, they're big like Harry Potter fans, so they do all that kind of stuff. So that's a Comcast property, isn't that right, Geetha?
That is a Comcast property, and you're absolutely right. I mean, it's for the younger kids, like the 2 to 10. I think Disney still continues to be the go-to. But once you get into the teenage years, yeah, you're absolutely right. Harry Potter seems to be like the bigger attraction. You find a lot of families going there. And Epic Universe is going to have a lot of that as well.
Also,
More
to be fair, can't they
focus.
just like hop over to Paris to go to Disney World there?
It's not the same.
It's not the same. Okay, well, fair enough.
Been there, done that. Hey, Geetha, I know Disney is really ramping up their investment in their parks, right? Didn't they like double their CapEx over the next some number of years?
Yes, $60 billion in CapEx spending over the next 10 years. Almost $12 to $15 billion of that will just be for new cruise ships. They're really kind of doubling down on the cruises. So that's going to be a big part of their business going forward. But absolutely, they're almost doubling their footprint in some of the areas, like especially in California, they're kind of going to double their footprint, going to almost add a whole new park in Orlando when all is said and done. So yeah, a big investment in the parks, and they're kind of hoping that's going to pay off as they keep increasing prices.
So I sent Paul an article this morning. It was like one of the first things I read that when it came in, that Disneyland raises prices by about 6% on the most popular days. So the most expensive tickets now, typically weekends and holidays, are climbing over 6% to $206 a day. At what point here are we capping out on price increases? I mean, if you have a family of 4 and there are 2 parents, it's $1,200 for one day.
I don't think we're capping out. I think, Paul kind of summed this up perfectly. Once you go there, you're not thinking of how much you're spending. And so actually, as we kind of model out the average prices, it's about $190 right now, the average, per capita spending per person. We think this pretty much goes to about $300 over the course of the next 4 to 5 years.
And nobody does it better than Disney. I mean, you got this little wristband, so you're not even physically taking out your credit card.
So easy to tap
and
go.
You just tap and go, and it's just
and you don't see it until you look at your credit card statement in like a month or something.
Exactly.
Right.
So nobody's better at it than Disney. All right, so Geetha, let's step back on the Disney story here. The theme parks, we got a good handle on that. Where are we in terms of profitability of the streaming business? Is this still a big headwind for the company and the stock?
Not anymore, Paul. So the turnaround has finally taken place. It happened last quarter, and we are actually going to see the streaming business now become a major contributor to actually the bottom line. So far it has been a huge drag. There were almost $4 billion in losses just a few years ago, but now we're seeing that it's breaking even. It's going to become a positive profit contributor Why? Because they're increasing prices. You're going to see a huge jump in your Disney Plus subscription come October 17th. They're cracking down on password sharing. That's something that they're just copying from what Netflix did. Again, that should lead to a nice bump in their average revenue per user. And then they've also introduced the advertising tier. And so advertising, which is already a pretty big business for them, they're really going to double down on that as well. So they have multiple levers that they're pulling now as far as the streaming business is concerned.
How is the stock trading? Is the stock trading encompassing all of this? Do you think it's undervalued, overvalued? I know you guys don't give actual valuations on the equity market for that, but I'm just curious as to see in terms of relative valuation.
I think in terms of relative valuation, it's definitely a little bit undervalued right now. And I think that's just because, we kind of have to wait for higher visibility in terms of the theme parks. So they have clearly said that the theme park business is going to be under pressure through most of fiscal 2025. So until we see like a nice ramp up in growth with the parks, I think we're going to see that somewhat of a negative sentiment and somewhat of that sustained pressure.
Boy, because it seemed for a while there, once they make that turn, that's when you want to dive into the stock. But I guess that's at a time where maybe the U.S. consumers, a little bit weaker on the margin, and that's going to hit the theme parks.
Compared to what you were saying or last couple of days.
Exactly. Yeah, I was spending like crazy. They're going to have a blowout quarter this quarter, Geetha. You can call it right now. All right, Geetha, thanks so much for joining us. Geetha Ranganathan, she is a U.S. media analyst for Bloomberg Intelligence. She covers all that stuff. Disney, obviously a huge name in that sector. And again, investors have been waiting for the turn in profitability for the streaming business. And it looks like they're at that point making that turn there to profitability. So we'll see to what extent they can ramp it. I mean, you look at the margins, the profit margins at Netflix, and I don't think Disney's saying they're going to get to those profit margins, but if they can get to something close to that, that's a lot of cash flow and a lot of earnings here for the company. So, but the stock, again, it's $167 billion market cap stock, but it's only up 2% year to date, and only up about 10% over the trailing 12 months. Badly trailing the market there, and that's been a real concern for media investors. The sector, tough for that sector to work if Disney's not working.
Yeah, absolutely. Taking a look at all of that as Hurricane Milton continues to bear down on Florida with, quote, house toppling winds.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I was just looking at NVIDIA. That is within a couple of points of its all-time high again. So there was a little bit of a sell-off there in some of those AI names, but they seem to be coming back a little bit. So see what's going on there. Kim Forrest joins us. She's a founder, and she's a chief investment officer at Bokeh Capital Partners. She's out there in Pittsburgh, and longtime technology analyst, really has some good views there. And I'd love to, Kim, I'd love to get your thoughts kind of on this AI trade. It had a little bit of a lull there for a while, but it seems to be coming back. How do you think about it?
Well, it's generative AI is the thing, and it has been the thing for, I don't know, maybe 24 months now. It seems like forever, but here we are. And every once in a while, people go, uh-oh, wait, it's wrong sometimes.
Right.
And then they go, wait, like it doesn't solve any problems, but we know it's cool, so should we keep funding it, as investors? And the answer seems to be yes. But there are fears, and I think rightly placed, that we don't really know how big this market is. We keep being told that, data centers are going to take over large swaths of America. I don't know that I believe that. I think my biggest problem with generative AI is it's unclear about what problem it's solving. And then that leads to the question, how much would you pay to solve this problem? And I don't have answers to either one of those. And I think that's what makes a lot of investors uncomfortable.
Well, maybe given that lack of comfort there and maybe some of the finer points of the AI story, is technology still a sector that can lead the broader markets higher like it's done for much of the last, 10 or 15 years?
Absolutely. I'm a huge, even though I'm like a little bit of a doubting Thomas here on the whole generative AI, I used to work in AI, and I know the power of the problems that it can solve. And they're much smaller than somebody talking to a computer and say, design me a new car, computer. Like, that's not a thing. Ridiculous, just one sentence problem solving. You know what I mean? But I do think that productivity is the thing that drives businesses to invest, and that drives technology companies to try to solve those business problems. And at the end of the day, that is what drives technology. Although people like to use it, it's fun, it's interesting, but they don't pay nearly as much as businesses do to run technology.
All right, Kim, we've got a Federal Reserve that is in a rate cutting mode. Maybe there's some debate about how far and how quickly they do that if you look at the bond market. But earnings, I think they still matter. And JP Morgan is going to really kick things off on Friday. What are you looking for out of corporate America in this earnings season?
Sure. Well, October is really the twitchiest earnings season because a lot of companies, didn't know if they were going to make their quarter because of the vacation schedule of everybody. So that always adds a layer of uncertainty to this time. But that being said, I think the bar was set low enough. I haven't seen very many, if any, pre-announcements from companies. That's still ongoing as they tally things, and the SEC forces a company to give meaningful material information to its investors. So we always look for that, but I don't see very much in the way of pre-announcements. Now, what we're going to now look at is what do companies see going forward? I think there are some questions about whether or not this economy is truly as strong as some of the numbers forecast. So that is what we're going to be looking for all season long, all earnings season, is do the companies see the next 6 months to a year strong, weak, or somewhere in between?
Do you think it's going to be Mag 7 or the other 493 stocks this time?
Oh my God, I wish Mag 7 would just take a break. Sometimes, oh gosh. But I think Mag 7 still has that generative AI magic going on. But there is room for other companies, especially in a declining rate. The smaller companies get bought by larger companies. And that's really been in quite a lull because of the high interest rate environment. Now that companies know that or have a pretty good idea that the interest rates are dropping, they are going to go back into the shopping mode, which is always exciting for me because I own some of those smaller names.
So small cap, again, we've heard it that maybe in a lower interest rate environment, they will do better on a relative basis. Certainly there's valuation there. Are there certain sectors on the small mid cap that screen well for you guys?
Well, there's technology. That's always good.
Yep.
And, one of our smaller companies is getting bought by Synopsys. So that's really the key here is a small company that can fit into the larger company's product suite or expand its total addressable market. That's what you're looking for in a takeover candidate. And I think just about every industry has, some smaller companies that could get bought by larger companies.
You like?
Like?
Yeah.
Oh,
I mean,
golly.
not
Well,
okay,
just
if you don't want to say individual names, just give me what are the sectors where that might make the most sense?
Well, there's banking. There's always banking, right? There's too many banks. There's that. Technology. There's lots of point products that would go nicely into a larger company's suite of products. Retail, not so much. God knows we love to talk about retail, but I think that looks pretty good for right now. Maybe industrials. Again, point products going into a larger company to allow that larger company to satisfy its customers with a broader suite of products.
Right.
So those are the key areas that I look at.
All right, Kim, thanks so much for joining us. Always appreciate getting your thoughts. Kim Forrest, she is the founder and the chief investment officer of Bokeh Capital Partners. They are out there in Pittsburgh, PA.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix, Paul, Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. So go over to that internet thing, go youtube.com, search Bloomberg Local Radio, and that's where you'll find us. All right. Sustainable aviation fuel. I didn't know it was a thing. Alix knows it's a thing. I did not know it was a thing. Fortunately, we have people actually do that stuff here. Anna Davies is one of them. She's head of renewable fuels at BNEF, joining us live here in our Bloomberg Interactive Broker Studio. Anna, I just use jet fuel. I throw it in my jet and I go. What is
He
sustainable?
doesn't have an actual private
I
jet,
don't
by
have
the
an
way.
actual-
Okay.
Just in my mind. What is a sustainable aviation fuel? What is it, and is it being used, and how well is it being used these days?
So, hey, nice to be here. What is sustainable aviation fuel? You use it exactly like that. You can throw it in your private jet and go, and it'll work just the same way.
Really?
It is, in its simplest form, molecularly pretty much identical to fossil jet fuel. The only difference is it doesn't come from fossil fuels. So mostly it comes at the moment from biofuels. So instead of having crude oil, you're using a bio oil. So something like soybean oil or used cooking oil, the leftover oils from your deep fryer.
Which would be the issue now, supply or demand, when it comes to SAF?
That is a very good question because everybody says we need more, there's not enough produced, there's all this demand that we need to replace fossil jet. But we have seen both suppliers and actually airlines kind of roll back their targets. Right now, the problem is it's expensive and nobody is really willing to pay it. So we see buyers not quite willing or able to step in to take it. And as a result, we don't see suppliers able to secure financing to build their facilities. So
That's a chicken and the egg type of thing. How do you think you solve for that? Is that bringing the cost of production down? Is it trying to stimulate demand somehow?
So we anticipate the cost of production. At BNEF, we try and calculate and model out
you guys
production.
are all about data.
Exactly. And we do not see the cost coming down to reach parity, really, like current jet fuel prices. It's always going to be a couple orders of magnitude above. So the real crux that's needed is policy. You need to have a policy push to either incentivize its uptake or force it. And we're seeing both of those policies developing.
Which basically what that means is that you have to subsidize the difference between SAF and regular jet fuel. And what the IRA did, it was really helpful in incentivizing the supply, but not the demand side of it. How close do you think that is right now?
So the IRA, the Inflation Reduction Act, does offer a tax credit for sustainable aviation fuel production, which does help to bridge that gap. There's still a lot of uncertainty as to what will qualify. You need to have a certain amount of types of feedstock in order to bring your actual emissions reduction down. That's a big issue in the market. It also is not only in place for a couple of years, which isn't going to help finance a 30-year facility. You see places like Europe taking the opposite approach, where they're just mandating blending in. So they're saying airlines and airports have to blend a certain amount, and that's going to ramp up over the next few years, sort it out, figure out the cost. And then you see places like Singapore, which is actually imposing a levy on airline tickets and saying, okay, we think SAF is going to cost this much in order to blend in. We have blending targets. We're just going to put an additional cost on airline tickets in order to cover the cost of SAF. I mean, we'll see what works.
In theory, that makes sense, right? Like you just pass it down to the consumer, but it does point out that any energy transition that you can do will eventually be then passed on to the consumer.
Consumer or taxpayer, yeah, probably.
Interesting. So what the U.S. airlines, all right, here I'm just reading some of your research here. So BNEF tracks airline net zero commitments and sustainable aviation fuel commitments, and currently 44 airlines, accounting for just under half of jet fuel consumed globally, have some SAF target, usually 10% by 2030.
Yeah.
Is that good enough?
Well, it's a target.
Okay.
So the question is, will they hit those targets?
Yeah, is it real?
Can they do that? And that's where we are starting to see some airlines procure SAF volumes, like United procures a lot. If you fly on, say, United out of San Francisco or LA, chances are there's some SAF in the tank.
Can they blend it?
They can blend it one for one. That's one of the beautiful things about
cool.
sustainable aviation fuel.
Well, only that, you can just easy replacement. Like you can just take the jet fuel out and put it back in, versus if you did a hydrogen plane or some other kind of plane.
Yeah, so you don't need new tanks or new aircrafts. You can blend it up to 50% currently is the regulatory.
Who produces this stuff?
It is currently produced in very small quantities. So right now, less than 1% of all jet fuel is sustainable aviation fuel. So we're talking very small volumes. It's produced, a lot of oil and gas companies and refiners are in on this space. So Neste, there's a company called World Energy and one called Montana Renewables that are producing at the moment. We're seeing P66 and Valero, through their partnerships with Darling Ingredients.
Those are regular refiners.
So does Valero, who does jet fuel today? Where does that
a lot of the refineries. So if you think of a refinery,
so you need to go talk to the refinery and say you guys need to put out more.
And a lot of them are looking at it because a lot of the process at the moment is similar. You basically, instead of taking a crude oil, you take a bio oil, you put it through a refinery and get sustainable aviation fuel. So you can actually convert some existing oil refineries to take bio feedstocks and therefore make these biofuels. So we are seeing them active.
What about so a different question. How do you think this industry develops? And where does the strength develop?
So a lot of this is policy-led. We are starting to see a lot of policies support it, though, because aviation is one of the crux. You can make these types of sustainable fuels into a whole lot of things. You can make diesel molecules, you can make methanol molecules, petrochemicals. But aviation is the industry where there aren't any really good alternatives, especially if you're looking at like a 2050 SAF or net zero target. Because hydrogen aircraft, electric aircraft, it takes decades to get those off the ground. It takes decades for fleets to roll over. So if you really want to decarbonize aviation by 2050, you're going to need to decarbonize the fuel that they're currently using. So this is the area where we're seeing a lot of policy start to move. I've mentioned a few of them. We're starting to see some interest from different producers. We're starting to see a lot of investment going into this because everybody assumes the market will get there. So for instance, there's a different way of producing it where you take green hydrogen and captured carbon dioxide to make the fuel. That's popular because you don't have the food versus fuel issues of a biofuel. Just earlier this month, we saw Brookfield invest over $1 billion into one of these e-fuel facilities.
I need to go check out one of these. Where are these things? Are they just like in Texas and Louisiana, where all the other
California.
California.
A lot of the fuel is sold in California, and a lot of the old refineries are being converted there. But they are being produced everywhere. It depends on where the feedstock is. So you can see a lot of feedstock in the Midwest. A lot of the production's coming out there. We're starting to see e-fuels, which take green hydrogen. They need to be near cheap renewable energy. And so you'll see a lot of these.
And is this fuel as efficient as carbon, the regular fuel? Because I don't want to be 35,000 feet in the air and then engine.
You're as reliable as what you're asking.
Reliable.
Yeah,
Thank you.
Yeah. So it has to produce. It produces Jet A spec fuel. There are questions if you had 100% SAF in your tank. Actually, a lot of the fossil jet fuels have some aromatics that end up in the jet fuel stream, and that actually helps with seals in the engine. So they're testing that out, but we don't have the quantities produced that you're anywhere near 100% these days. And in general, you could think of it as exactly the same as jet fuel.
See, isn't she awesome?
She is. I mean, all these people we haven't had like a clunker yet out of any.
No,
they're all
but
good.
I've known her for a long time. She used to cover literally everything at Bloomberg Intelligence. Like everything. Not BNEF.
Yep.
It was like oil, it was gas, it was all the things. All right, Anna, it was good to see you. Thanks so much, Anna Davies, head of renewable fuels over at Bloomberg BNEF. It's where we get all the data that you need to know about the energy transition. Honestly, from oil to gas to hydrogen, we get it all for you.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.